Question we're often asked has to do with sort of the financial dynamics of some of the calculations in the current liabilities as well as in the wealth impact section below. So this is a quick video to cover the two key areas. I'm going to just give you a quick review up here at the top. The current liabilities, or whatever liabilities you choose to show, are going to be totaled here as a total loan amount, and they're each broken out individually. For each liability, we show their pre-tax and after-tax return. An auto at 7% will be 7, a credit card at 7 will be 7. But what we developed was a way to show the after-tax rate of borrowing. So a 5.75 30-year fixed mortgage today, after the tax deduction, is really a 3.910%, meaning that while they're paying 5.75%, they're generating about a $398.16 per month deduction. If you took that money and said, hey, this is kind of like free money, I'm actually not having to pay the full payment. I'm paying $1565.38 minus the deduction I'm getting. My effective interest rate is 3.9. It's a very cool way to explain to people how tax deductible versus non-tax deductible debt plays out. And you can see here the pre-tax weighted cost of borrowing of 5.994 means if you take each balance and weight it by the actual pre-tax rate, you can see this is your average cost of borrowing. On an after-tax basis, you'll notice it's the same thing. So this client has an average cost of borrowing today after tax of 4.356% for all their borrowing, a pre-tax cost that's an average of 5.994. Now over here we see the remaining payments. There's 68 payments remaining on the auto, 339 payments estimated to be remaining on the mortgage, and 70 on the credit card. Now what's this number right here? This is another really cool feature. What we do is say, you only have 68 months to go on this debt, this auto. You only have 70 months to go on this credit card. And you're spending a total of $2,038.68 per month. For a lot of people, they know they can spend that amount right now. That's what they're spending today. What we do is we just go ahead and do a quick calculation that says if you continued spending $2,038.68 per month going forward, how long would it take you to pay off all of your debt? And the answer is 230 payments. So we can see here this client has less than 20 years to go if, as these debts are paid off, they just continue to make that same monthly payment towards their existing liabilities. You don't have to just go through all this with your client, but this is some really interesting information for telling a story and looking at their current borrowing. Below that, we just do the same thing. You look at your new debt, your borrowing. They're borrowing $236 versus $242. I can see their after-tax cost is going from 4.3 to 2.781. Their payment $2038 to $1747. Their tax deduction from $398 to $301. And you'll notice the payments here say $261 instead of $230. Why is that? That's because at this point, that is the number of payments they would have remaining if they just paid $1747 a month. So if they just drop from $2,000 to $1747, you can see they'd be spending another 31 months to pay off all of that debt. But look at how much they're spending. They're spending a lot less. They're spending about $280 or so per month lower. So we're not going to talk about closing costs here, the payment difference, that's the $292. But I want to talk about the wealth impact. If you want to cover wealth impact, we give you a couple of ways to do that. We give you a fixed option or a minimum payment option. Now the fixed option is the most accurate way financially to compare the wealth impact for the client. Because what this does is it takes the highest payment that they could be making in any scenario and says, to be fair, to compare the true financial impact of these decisions, you need to make the same payment each month. So in this case, they're spending $2039. You can see that here. Here we give you the exact number, $2038.68. And if I have this set to fixed and I refresh, it's going to make sure that on each scenario I have, they spend $2,038.68 per month. So no matter what you do below here in terms of time frame or what other assumptions you want to change around for appreciation or after-tax savings rate, this is going to make sure that we're calculating a fair apples-to-apples comparison. And here's how I can explain this to the consumer. You're going to spend $244,642 over the next 10 years if you keep doing what you've already done here in blue. We're offering you a new scenario, a 30-year fixed at a lower interest rate, and we're going to assume that you spend $244,642. That's the only way you could accurately compare what they're doing now to something else. Now it assumes that they're going to make the same monthly payment going forward. As these debts or liabilities are paid off, any extra money that's available will automatically be applied towards their existing mortgage if they click repaying, or towards saving if they chose to save. So what happens here, if I check savings, then after the payment is paid each month on the mortgage or the credit card, if there's any cash left over, it's going to go into a savings account and it's going to grow at 3%. So again, if you think about this, what we're really doing is making it easy for you to explain to the client on an apples-to-apples basis the value of your advice. And a lot of time and money went into figuring out the best way to do that. Now, if I want to go into repaying, then the money isn't going into a savings account. The savings account disappears. Any extra cash or cash flow would automatically go towards the mortgage, and we're going to show the wealth impact again over that time period. But because you're now applying that towards the mortgage, you're saying, hey, for the next 225 months, you're going to spend $2,038.68 compared to $2,038.68 for the next 192 months. And you can see at the end of 192 months, you're debt-free here compared to here. Another way you can do that is 192 months. If I slide this out to about 14 years, see how the mortgage balance is going down? 15 years. So about 16 years should get us there. So I still owe $52,141 after 16 years. Here I'm at zero. And this is another compelling way. And notice once the mortgage is paid off, that extra money, there's no more debts anymore. I'm going to start putting it in their checking account, earning 3%. So we're always accounting to the penny for the exact monthly amount that's being spent. And we do this for you automatically if you click the Fixed At button. If you click the Minimum button, and that's what some people are used to using, then we're only going to make the minimum payment that's required on each debt each month. You're no longer really comparing apples to apples now. I'm now comparing $2,039 per month spent here to $1,747 spent here. Now in this scenario, this extra $292 could go into their checking or savings account, or it could be spent on lattes and going to the mall. But we're not going to account for it here in terms of the real financial impact over time. So you can do this if you want to get into sort of a manual build. And I say manual, some people will use minimum, and they'll go through and they'll come in here and say, I want to add a payment of $292 per month, and I'm going to pay that monthly until the loan is paid off. And they'll go through and kind of rebuild what we've done above here and show it that way. The problem is if there are any payment adjustments, tax adjustments, or whatever, you have to account for all of those manually in this process. You have to add payments to get that figured out. Whereas up here, if you do the Fixed At, we're going to adjust that for you automatically each month. And if you do that, you wouldn't need to add these extra payments. So I recommend you start with a simple scenario and then go through and compare it. Now, if I was going to show a 15-year fixed, and that was really an option, that 15-year fixed payment is going to be a higher payment. Right, my payment's going to be possibly $2,044. So when I click the refresh button, again, you'll notice an adjustment. It's going to make sure, because if the 15-year fixed is an option for this client, that means they could just as easily pay $2044 here or $2044 here. To be fair, we're going to apply this against each. I could keep my old mortgage and pay $2444.30. I could get a new 30 and pay $2044.30. I get a new 15 and pay $2044.30. And this is going to, again, go through and look at what's the financial impact of each of these scenarios side by side. 3.5 to 3, lower interest rate, greater savings over this time frame of 15 or 16 years. And again, everything's being accounted for you automatically. So choose how you want to do it. We recommend you use Fixed so we can do the math for you. If you want to do it yourself or you've got a special situation, you can still use these same controls. I can use the Fixed at $2044.30. And if I choose to, go through and make further modifications to the payment here. So that's a deep dive into the wealth impact and how it relates to the scratch board above. Hope this helps. Again, if you have any questions, feel free to give us a call. Have a great day.